Welcome to Views from the Top, Livewire's one-on-one interview series bringing you closer to the best investors and ideas on the planet. I'm Huntsley, and thank you very much for joining us. Our guest today is Harry Colvin, Director and Senior Market Strategist at Longview Economics. Longview are a London-based economics consultancy firm who turn macro noise into asset allocation insights. And today, Harry's going to share with us where the best signals lie for 2025 and beyond. Welcome, Harry. Good to have you with us.
Thanks for having me.
So it has been another busy year in financial markets. I'm curious, for somebody like you who's so dialed into markets, is there a moment or an event or a theme that really stands out to you the most?
Well, the complacency, the strong sentiment, everyone seems to be very bullish about the equity market as we go into 2025. And, strategists are falling over themselves to be bullish, aren't they? So, look, I think when you look through history, it's very rare that you have a series of very strong equity market returns like we would have if strategists are right about another strong return next year. And our view is actually there's a lot of complacency, the sentiment is too much, and these types of consensus views often get it wrong, don't they? So I suspect we see a crack in equity markets next year, and there are a number of technical reasons certainly to expect that, not least the fall in participation. It's clearly a bull market that is getting tired. There's a lack of breadth.
When you say participation, you're talking about investor participation, you mean?
Yeah, you can see it in volumes. So if you look at E-mini volumes, for example, they've fallen quite sharply since the summer. Often when volumes fall like that, it tells you participation's fading, and it's a good sign that you're about to get a crack. It's got strong predictive power. Cash levels are low, so investors are all in, and that's normally the time the equity market gets vulnerable.
I was going to say, with that view then, I guess you'd be more in the Bank of America view, who are forecasting an S&P 500 of 6666 by the end of financial year 25. I guess, is it appropriate to say you're more in that view than you are, say, in the JP Morgan or Morgan Stanley view, which would be US exceptionalism, keep buying into US stocks, buy the Mag 7 on dips, that kind of thing?
I think what we're talking about is a return to equity volatility next year. And within that, where it gets interesting is the rotation idea. The fact that we've had this very strong leadership in the market, Mag 7 stocks, the long duration growth parts of the market have done very well. That's where the positioning is really crowded, long, and it's expensive valuations as well. So I think that part of the market loses steam, and momentum's already started to fade there. If you look at, say, the Philly stocks, it's gone nowhere this whole year. Actually, Nvidia has started to lose a bit of momentum in the last few months, but we're starting to see leadership in small and mid caps or in S&P equally weighted. It's a rotation theme next year, really.
Okay, all right. Well, we'll come back to that. I read the notes from yours and Chris Watling and your team, and I love that one of the recent markets notes was actually entitled "The Market is Concerned." So, what, in your view, are the markets going to be most concerned about next year?
Well, at the moment, clearly they're super concerned about inflation. The biggest tail risk, if you look at the Merrill Lynch Fund Manager Survey, for example, is that inflation will re-accelerate. It's more of what we've seen in the last few years. I think those concerns are overdone. Actually, inflation looks like it's dissipating to us. Certainly, if you look at service sector inflation, it's trending down. Wage growth is soft and decelerating pretty sharply. That's what drives services inflation. And the labour market is super weak. And so wage inflation probably goes lower. I think inflation dissipates, and probably Trump tariffs aren't going to be as inflationary as some might fear.
Okay, well, let's dig a little bit deeper into that inflation topic if I can. Obviously been the topic du jour for 4 years now. It's been a long road to get it back to target, and we in Australia are very, very familiar with that story. If Donald Trump initiates the full pledge of his tariffs, what do you think will be the impact on markets of those tariffs on inflation and growth? I think you were just saying that it may not be as much as markets maybe are fearing.
Well, markets have priced in the tariffs. They know tariffs are coming. Our sort of back of the envelope numbers tell you if you do a 15% blanket tariff on all goods imports, and let's not forget the US consumes about half the goods it consumes come from imports. If you just put 15% on that, we think total CPI goes up by 1.3%. And it's a one-off. It's a one-off increase in the price level, so it rolls out the numbers a year later. And most of it, of course, is on durable goods, which at the moment is deflationary. Durable goods inflation is minus 2.5%. Last time Trump imposed tariffs, actually it wasn't that inflationary. Durable goods inflation went, once again, from deflationary levels towards about zero, just above. Our view is it's going to be something similar this time. Maybe we go a little bit above zero, on durable goods inflation. The key point is service sector inflation is 4.7% at the moment, and it's going to be going much lower over the next year or so. So you add it all together, you end up in a disinflationary environment in the US, and that supports this long bond view.
Okay, that's really interesting. What's the biggest risk to that thesis?
Well, one risk, there are lots of risks, as always. One risk
Always.
is, one risk is that Trump comes good on this mass deportation plan, and he's somehow able to deport millions of undocumented workers. That would cause chaos, it would tighten the labour market, it would be inflationary, it would push wage inflation up. So that's a risk. Our view is probably he won't manage to import anyone. I suspect it'll be a little bit like last time when he said he'd build the wall and it didn't happen. It's a political line that helps him along the way to winning the election. If he is able to deport anyone, it's probably in the order of a couple of 100,000 people, I would imagine. But there's a lot of slack in the labour market. You've got 1.2 million people who are marginally attached. In other words, these are people who want a job, but they're not in the labour market. They've looked for work in the last year, but just not in the last 4 weeks. And they're waiting in the wings to come back into the labour market if it tightens up a little bit. So that's an interesting piece of context for thinking about these deportation plans.
Okay, interesting. So that's tariffs in the US, so we can put that to one side. Beyond that, what is one risk that you think markets should be paying more attention to? And I note that you're based in Europe and there's no shortage of things going on there at the moment.
Well, there are lots of challenges in Germany and France, particularly politically. Germany, I think, is in a lot of trouble. It's had one of the largest, in fact, the largest increase in unit labour costs cumulatively since the GFC of all the Eurozone economies. In other words, it suffered from a very significant loss of long-term competitiveness. And so what you find in Germany is that unit labour costs are growing faster than nominal GDP, which is a good proxy for revenues. In other words, costs are growing faster than revenues for companies, and so they're experiencing a margin squeeze. And therefore, these companies are looking to retrench and cut costs, which is really what the recession dynamic is. And you look at German hiring plans, they've collapsed to pandemic levels, before that to GFC levels. And usually that's a good lead indicator that employment will shrink, and it's already started slowing a lot. So I think a contraction in employment in Germany looking very likely. A recession in Germany is coming. The interesting angle on that, of course, is the ECB is in cutting mode, and a German recession probably helps them along the way to cutting policy more significantly. And I think that then reflates and stimulates, in particular, the periphery. We've got a thing we call the return of the pigs. You'll remember those countries from the Eurozone crisis: Portugal, Ireland, Italy, Greece, Spain. These countries, I think, will do very well on stimulus from the ECB. And we're already seeing that, in fact, if you look at the small cap indices for those parts of Europe. France is struggling as well politically. I think we don't want to assign too much weight to politics when it comes to markets. Most of the time, governments countries can go without a government for a while and they're fine. I wouldn't read too much into that. Really, what drives the equity market is liquidity and monetary policy and earnings growth and so on. And what you find with Germany and France and other what we call Northern European Eurozone economies is that they're really struggling. And it's the parts of Europe that have undergone the most painful economic adjustments in the last 15 years. Greece, Ireland, Portugal, Spain, massive deleveraging, massive creative destruction with that. They've got their houses in order, and now they're beginning to grow from a much stronger base. And so we're seeing really good earnings growth there, and these are very cheap markets. A number of them are trading at 50% discount to the US if you look at a forward PE. I mean, they're super cheap relative to the US, but they've got better earnings growth. And they've got the stimulus from rate cuts coming through. And really, I think the key theme in Europe is that the housing market has been shut because of prohibitively high mortgage rates. Once you get rates down, housing markets reopen, the savings rate comes down. In Europe, the savings rate is close to 16% of disposable income.
Oh, wow.
So, you get that down because confidence comes back because of rising wealth effects and house prices and so on. You get a mini consumption boom in Europe, which is not something people are looking for. It's quite a non-consensus view. Above trend growth, economic and earnings growth in Europe, I think that's looking likely.
Okay, so that's the situation in Europe. I take it with what you were saying with the US, a recession is not your base case in the US,
Correct.
just quickly? Yeah, okay. So US recession, not your base case. Europe is a little bit mixed depending on which part of Europe you're in. And you mentioned small and mid caps a couple of times, which leads me to this next question. We've talked in the past about global stock market leadership and just this magnificent seven and this incredible run that they've had. Is there any sector or style that is able, in your view, to genuinely challenge tech's leadership over the next 12 to 18 months?
Yeah, absolutely. We're all conditioned to believe that tech and growth is going to outperform forever.
Forever and ever and ever.
But it never happens like that. You look through history, and on average, you get changes in sector leadership every 6 to 8 years. And typically, the switch in leadership happens when, firstly, you get very large valuation divergence between the leading part of the market and the lagging part. And secondly, you get it when there's a change in the macro theme. And I think that's what we're getting now. We're moving from a world where global central banks have been tightening policy very significantly. Suddenly, there's now a global central bank policy effort to loosen. And that will reflate cyclical earnings that have been struggling for the last couple of years. Certainly outside of the Mag 7 and in the rest of the S&P 500, but also in UK, Europe, Japan, across the rest of the world, weak earnings, which will be reflated on looser monetary policy. So that change in the macro theme, I think, is key for driving rotation.
Okay, so mentioning rotation a couple of times, rotation into what specifically? If I could just press you a little bit on that point.
No, quite right. I think into cyclically sensitive parts of the equity market, into value stocks, into mid and small cap parts of the market. Mid and small cap, let's take those, for example, in the US. Yep. They've had a really tough time. Since 2018-19, we had that slowdown in the US economy. They underperformed. Then we had the pandemic, they underperformed more. Then we had this very large rate hiking cycle in the US. They underperformed again. And they're now very beaten up, not just in terms of price relative to large cap, but also in terms of their valuation. They're super cheap now. So these parts of the market are looking very attractive. Value stocks, it's the same kind of story. So I think if we get a switch in the macro theme, then we get rotation into these parts of the market.
All right, so that's equities. 2024 has also been a year for elections, and that's obviously meant that fiscal spending has really been in focus. You talked earlier to a long US duration view, but more broadly, what is your view on fixed income as an asset class for 25?
Well, it's a good question. I think, for us, for the next 6 months, treasuries rally and they do very well, and we need to price in some more cuts at the very front end. And you think about a setup where you've got a weak labor market in the US, inflation is dissipating, the Fed probably want to take policy back to neutral. And on their numbers, neutral is about 2.9%. So I think pricing in more cuts, we're priced for a couple for 2025, I think we probably need to price in a little bit more. So until the narrative changes, until sentiment and positioning and other technical factors change as well, then I think a rally in treasuries is got to be the right bet. And look, then as we get into 2025, let's see. I mean, we can review that. But for now, I think long duration is the right trade.
Is the way to go. Last asset class which I want to touch on is commodities. I remember when your colleague Chris Watling and we had a chat. I remember in our old offices, in our old studios, and I remember he was talking about gold and how it was due for such a breakout. Boy, has that breakout happened. Yeah. When you look at the commodities complex now, what is one commodity you are bullish on for next year, and maybe what is one commodity you are more bearish on?
Well, we like gold. The dollar is super overbought. And the gold-dollar correlation is starting to reassert itself. So you get a weaker dollar, that supports gold. And as I say, gold's oversold. So, gold I think will do pretty well. We also like oil. Oil's at a very key level, starting to find a bit of support. Everyone is bearish on oil. I would have thought oil can rally. It's not going to be a huge rally. If you look at global oil inventories, we think they're going to be flat for the next year or so. And that will put a bit of a cap on the upside in the oil price. And then in terms of commodities to be bearish on, as certainly as we look out over the next few years, I suspect it's the Chinese sensitive ones. Iron ore has to struggle with China in an ongoing balance sheet recession. China's just had the biggest asset price bubble in modern history, and it's burst, it's now deflating. And so I think commodities that have been feeding the construction boom in in China clearly come under a lot of pressure over coming years.
Well, finally, sir, I understand you've been at Longview for a long time, since early 2006. So, with that in mind, what is one thing you have become privy to that you wouldn't have realized or had access to if it were not for the position that you're in today. Harry Colvin, what is your view from the top?
Good question. It's difficult to know, isn't it? Because you don't know the counterfactual, what you would have otherwise found out if you'd made other decisions. But look, I think one observation I think that is always striking to me is that when you're trading markets and when you're investing, it's the decisions you make that are the most uncomfortable ones. They're often the best ones. Whatever seems easy, whatever seems comfortable, normally it's going to lose you money. And I think that's our approach to markets, and I think that's the way to add alpha.
Harry, this has been fantastic. Thank you very much for joining us, and great to have you out here from London as well.
Thanks for having me.
And thank you for joining us. If you enjoyed that interview, you can subscribe to the Livewire Markets website, as well as our YouTube channel, where you can find more views from the top. Until we see you next, thanks for watching.